Hi, and welcome to the Millennial Money Canada podcast, a podcast to elevate your financial planning literacy so that you can live well, build wealth, give generously, and leave a legacy that you're proud of. I'm Guillaume, Girard, financial planner, and I'm joined by my co-host, Sam Lichtman, founder and financial planner at Millennial Wealth Advisors. The topic of today is what every investor should know, 10 key concepts to help you improve your odds of success in the financial market, make you a better investor. But before we dive into the topic of today, we've had a significant change in the political landscape in Canada on Monday. So Sam, do you want to talk about what happened and perhaps the implications that it may have on, all the things that are, we touch on, right? Whether it's taxes based on the conversations you've had with people in your network?
Absolutely. So yeah, quite an eventful week. I don't think to anyone's surprise, we saw Prime Minister Trudeau resign or intend to resign on Monday, which triggers a election race or a leadership race for the Liberal Party, which is going to culminate in a new leader, which will then interim replace Prime Minister Trudeau once a new leader is chosen until there's an election. So it's a little bit of a messy situation right now. Especially given some of the trade issues going on with the United States and potential tariffs and all of those things, who's going to be leading those negotiations. But what's going to happen and what's more important and what is actually applicable to some of our clients is there were some budget measures that were put into place in April of 2024, which by Trudeau proroguing Parliament, which just basically means he cancels this sitting of Parliament, those measures have yet to be passed into law. And so basically what that means is there is no actual legal recourse to enact any of these measures. So a few of the most important ones were the capital gains tax increase from 50% inclusion rate to a 66% inclusion rate on the sale of assets over $250,000 if you're an individual, or on any dollar if you're a business owner. So if you have capital gains inside your corporation, you sell assets or investments, every dollar inside of a corporation gets taxed at that new 66% inclusion rate. Effectively, what it does is it bumps up the effective tax rate from 25% to 33%. And so with that, and there was a lot of speculation around the CRA can't actually enforce that because it's not law. But the CRA actually came out and clarified their position and said that they are going to be continuing to collect at the higher tax rate as if it were law. Now, I'm not a lawyer, but I have heard some legal opinions on this in that it could get very messy if someone were to challenge the ruling of the higher tax rate if there is no law around it. Now, there's going to be likely a situation, and as advisors, we're going to have to navigate this situation very intentionally with clients, because the only way that this becomes law is if the government, when they come back in March, is not defeated on a non-confidence motion. So all opposing parties, the Conservatives, the NDP, the Bloc, have said they're going to oppose government when they come back in March. And the government's going to effectively try to continue running by passing a supply bill when they do come back in March. But that is a confidence vote in and of itself. So if they oppose the supply bill, like if the Conservatives, NDP, and Bloc oppose the supply bill, then that will trigger an election. So that means that then that legislation cannot get passed again. And so effectively, if there is going to be an election, let's say May, because that would trigger an election race, which would be anywhere between probably, I think 20 days is the minimum, but I think it could be as long as 90. That could trigger an election where the new Liberal candidate, if they wanted those measures enacted, would actually have to campaign on raising the capital gains tax rate to 66% for an inclusion rate, which I don't see as an effective campaign strategy. That may or may not actually happen. So anyways, lots to think about, but there's one other important measure, which is the charitable donation tax credit. So because of the Canada Post strike, the CRA had extended the charitable donation tax credit to February 28th of 2025 to be applicable for 2024 donations. Now, again, that's something that was wiped out with the proroguing of Parliament. However, that is, again, CRA's mentioned that they're still intending to enact that legislation. even though, again, the law it didn't actually get passed into law for this year. So there's a lot of things up in the air. At the end of the day, any transactions that have already happened in 2024, the government will try to collect at the new tax rate. And then who knows what's going to happen if there's a new government early in 2025 or mid-year 2025. Are they going to refund that excess tax? Is the government going to look at their revenues and say, well, we're not going to refund, but we're going to wipe it out going forward, right? Because that sometimes happens with new governments. There's a lot of things that are up in the air. Kim Moody, who is one of the foremost tax experts in the country, has some really good analysis on this. So I would encourage everyone to go to his Twitter and X page or LinkedIn page. He's written some articles for the Financial Post regarding this. So go check that out if you want more information. We can link those in the show notes. But yeah, it's a bit of a crazy time. Like, yeah, I mean, I won't go too far into my personal opinions on this. I think probably most of the people who've seen me over a long period of time probably know where I stand on this. But at this point in time, this is when you feel like governments need to step up and actually show real leadership. And what's happened now is they've run away in the face of pending tariffs, in the face of a pending hostile US administration towards Canada, in the face of tax changes where it leaves Canadians just completely uninformed and unaware of what's actually supposed to take place. It's not a good look. And so hopefully we get clarity on all of this. Hopefully things go back to normal in a few months, but here we are.
Wow. So coming back to the change in the capital gains inclusion rate, of course, it's always important to ask the opinion of a tax expert here. But would you agree that the recommended path forward would be to pay taxes based on the new inclusion rate as stipulated by the CRA? And then if there's a amendment, or if there's a cancellation of that or a revert to the previous inclusion rate, then like as you mentioned, we don't know if this is going to be a refund or how is the CRA going to navigate that. But is that the path going forward for most clients for any capital gains realized in 2024?
If anyone watched our last episode or a couple episodes ago with the Canadian tax guy, I think this perfectly sums up what's your tax risk tolerance. Because let's say you do only make the required payment or the payment at the lower tax rate, then technically penalties are going to start accruing on the outstanding balance that you owe. Now, will those penalties be forgiven is the big question. So are you willing to risk essentially what we don't know is going to happen, but what is probably likely to happen, which is these will get squashed. Like these tax rates are probably not going to increase. Are you willing to risk that in order to potentially pay the lower tax rate without waiting for the CRA to then potentially refund you? Is the new administration actually going to look at the revenues collected and want to give a refund? Governments typically will come in and they'll say, well, things are worse than we thought, so we've got to, look really hard before we make any changes. So that is something that, you're going to have to talk to with your tax accountant. You're going to have to figure out, do I have the risk tolerance to say, and basically say, no, I'm standing firm. I'm not going to pay the extra excess rate. I'm just going to pay what I think is going to be the actual applied rate if there's a new administration change, and risk paying interest on the penalties and then having to pay it anyways. So it's not a firm answer, but it depends on your tax risk tolerance, and seek first advice of your accountants.
Yeah. In summary, is it worth it to carry potentially interest charges, or does it make more sense to actually just pay it now at a higher rate and then see the recourse going forward? So I guess that's a trade-off that someone can make, like you mentioned, based on their risk tolerance and probably the size of the positions as well, and how much money we're actually talking here, relative to other aspects of their financial affairs. Right?
Yeah.
Oh, interesting.
Absolutely.
Do you know, this is a side topic, do you know if this situation has occurred previously in like recent history where current government is basically proposing some amendment or changes, and then, we get into this limbo situation where everything is on hold and then might be reversed? I know you're very politically, in tune. So yeah, can you recall a few events that we've seen in the past?
My political knowledge probably is deepest within the last 10 to 15 years. But I would say that anytime a government prorogues parliament, or prime minister prorogues parliament, effectively any pending changes are wiped out. So the last proroguing of parliament we had was Stephen Harper when he won a minority government and the opposition parties tried to form a coalition government against him, they would have had a majority. But the Governor General turned it down in Harper prorogued Parliament, and then essentially maintained his position as minority prime minister. So I don't know specifically what was on the table then, but I do know that by proroguing it, it kind of wiped out any legislation that was pending. So that's the case anytime governments prorogue. Again, I'm not too familiar with every time governments have prorogued Parliament, but that's the most recent one with Harper. Yeah, it's happened before. I doubt that it's happened with such significant tax changes being on the table. But I don't think governments in the past have so significantly amended the tax code like this administration has.
Interesting. What a situation. Let's see. I think we covered that pretty well 2 episodes ago with the Canadian tax guy, and trying to refrain from making decisions, short-sighted decisions, essentially. And that's why working with professionals, taking a long-term view, weighing the probabilities or the impact of making certain decisions on, again, your other financial affairs. I think it's the key here, not trying to predict exactly what's going to happen. And I guess that's a good segue into the topic of today, which is to share with you 10 ways that you can improve your odds of success in the market. And we'll talk to you about a few different ways that there's 100 different ways you can make money in the market, right? And we want to share with you in this episode what are some of the things that you can do to make your life easier, but also improve your probability of success over the long term, based on science, based on research, based on deep history, looking at for the past 100 years, what have we learned, and what has the data shown us as investors, and how can we make the best decisions by looking at that. So there's 10 different topics that I'm gonna touch on.
Because we're going to be diving deep into investment topics today, I want to provide a quick disclaimer. Both Guillaume and I are licensed mutual fund representatives and financial advisors. And in our topics today, we're going to be mentioning some companies, and we're going to be talking about different strategies. This isn't us advising you to go ahead and take what we're saying and apply it to your portfolio. It's really, really important to understand that you need to get professional advice before implementing anything you hear online. We're going to be going through different strategies, topics, and talking about different companies that we use in our portfolio management. All investments that we talk about today and all investments that we have access to are provided through Portfolio Strategies Corporation, our regulated investment dealer out of Calgary, Alberta. Before you go and implement those on your side, make sure you talk to a professional licensed financial planner. If you want to talk to us about this stuff, you can do so. The link is down below, and we'd be happy to chat.
So first question is, can professional fund managers predict which stocks will go up or down? Sam, what do you think?
It's a good question. So I want to back up a second here just to say, what we're going to be talking and covering here is mostly from you're looking at your different mutual funds, ETFs versus mutual funds, or active managed mutual funds versus passive investment alternatives for clients. So this question, can professional money managers predict which stocks will go up and down? Just for those people who maybe don't know everything about fund managers and fund management, when you buy an actively managed mutual fund, the portfolio manager and the fund itself will charge you a fee. And anytime it's actively managed, which means the portfolio manager is trying to pick stocks that will outperform a certain benchmark, that's going to be a higher fee than if you were to, say, invest in an index fund, which simply tracks an index like the S&P 500 or the S&P TSX. And so the question really is it worth it? And can professional fund managers predict which stocks will go up and down? Without having studied the research necessarily too much in today's episode, my answer to that would be, I don't think they can reliably predict which stocks will go up and down, because no one here has a crystal ball. And even if they have the best information, using ridiculously expensive computer models and running thousands of simulations, what ends up happening, in my opinion, and I'm curious to hear what you think, what ends up happening is that the next day, the next hour, new information will come in that is unknowable in this minute, which will change the trajectory of those individual securities that they're trying to pick that will go up or go down. What are your thoughts, though?
Yes, before I share the exact statistics or the research that was published by Dimensional Fund Advisors, I want to just touch on, who is trying here to beat the benchmark, as Sam mentioned. okay, what is the industry looking like? And I was on that side before, one part of it on the technology side. But you have what it's called the investment banking arms at banks. Now, banks are large institutions, and there's many departments within a bank, whether it's private wealth, asset management. But you have the investment banking arm, and this is called the sell side on Wall Street lingo. And in this department, they have what they call a sell side analyst. So those are analysts that are covering specific companies, and they're giving their recommendations as to if you should buy them, hold them, or sell them. Now, the joke is that they will never recommend to sell those companies. And here's why. The banks, the investment banking arm of a bank, there's the research department, but there's also the investment banking side that helps companies to raise capital, whether it's through equity, so issuing new shares and then finding investors to buy those shares, or through the debt side. So when company needs to borrow money, they will utilize a bank, and then the bank is going to assemble a syndicate to find people who will be able to or willing to be lending money to them, and then the company is going to pay them a coupon, which is the debt side of financing their operations, right? So there's two sides. There's the equity side and there's the debt side of financing. But think of it this way, right? If you want that company to work with you, and your sell-side analyst has a sell rating on your stock, how do you think that relationship is going to work out? Now, this research from the banks, they're supposed to be, independent and objective, but it's just inherently, there's biases that are inherent in this whole relationship.
So it's interesting. Just to quickly interject here. So I'm in the middle of taking my Chartered Investment Management designation, or the CIM designation, which over time would allow me to become a portfolio manager. But there is some regulation when banks and investment banking's arms are trying to raise capital and then also simultaneously issuing a rating for those companies they're trying to raise capital for. I think there's like a 2-week or something like that. I could be wrong on this, but I think there's like a 2-week period where they can't issue a rating on that company. And the regulators take that fairly seriously. I think there was just actually recently some news where an investment banking arm got fined for, that might have been actually something related to sharing confidential information with a third party. But anyways, yeah, so there is some regulation in that, but it's interesting to know because it's like such a short time frame that you kind of feel like that might be influencing their buy or sell ratings.
Yeah, and I'm not here to start speculating and whatnot, but I used to sell data to those guys. And if you just look at the relationship, right, the incentives are there. It's like any other relationship. It's like if you're in a business where you have clients, you want to do well for your clients, you want to service your clients well, you don't want to tarnish that relationship. So it's the same thing. It's a human thing. It's nothing against the people who work in those departments. It's just the nature of the industry. But the sell-side analysts at the banks, what they also do is they work with buy-side analysts or portfolio managers. And those are what Sam mentioned. Those are the mutual fund managers, the big asset managers, the pension fund managers, big insurance companies as well that manage big portfolios. But those investment mandates might be different sometimes depending on the liability side of things and how they manage their portfolios. But ultimately, the sell-side analysts are trying to pitch their ideas or their best ideas or their recommendations to the buy side, which is the ones who are having the capital and make the investment decisions, so the buys and sell decisions. I wanted to walk you through this landscape so that you can understand how many people are involved in this decision-making process. There is a lot of smart minds on both sides, whether working for the bank trying to find the best companies or the best opportunities in the market and pitch it to the mutual fund manager. So the mutual fund managers, they really have everything at their disposal. They have in-house hundreds, if not thousands of analysts, depending on the size of the firm. They also rely on the bank's advice as far as what they think based on, again, their relationships with their clients, and then other third-party and objective research arms as well. So the mutual fund managers are armed with almost unlimited budget in some occasions of how much to spend to get the best information. And then when you go to the hedge fund side, then it's even more intense as to where they spend their money to get the latest information. So it's a very, very competitive landscape. There's a lot of really smart people that are playing that game. And that's why sometimes when we see retail investors trying to play that game as well, it's oh man, this is David versus Goliath battle here, right? So you're competing with extremely, extremely smart people. And those smart people, also use different strategies as well, right? So there's 3 main categories that we can look at. There's fundamentals, So where they're looking at, a specific model or the value of a company, and they're trying to identify is the company overvalued or undervalued. There's going to be the technical side, which has been laughed at a lot, where people might look at charts or kind of bridge, I guess, between fundamental and quantitative. And I'm not talking about like dojis and, candlesticks necessarily, patterns and stuff, but the technical analysis side of things has been laughed at by professional money managers like over time. But it's a very popular way of trying to analyze stocks, especially currencies, for retail investors. And then there's the quantitative approach, where the human decision is basically taken over by a program or a certain model that will dictate the buys and sell decisions. So depending on, again, whether it's the algorithm that is in tune, and there's quantitative analysis can go pretty deep, right? Like whether you're looking at like deep learning models and whatnot, and this is like way beyond my knowledge, but there's all sorts of models you can apply. But ultimately what you do is you turn over the buys and sell decisions towards a systematic approach. So there's no human or gut feel intervention here. So those are kind of the three types. So, and it's a lot of, like I mentioned, smart people using all sorts of strategies trying to predict what's going to happen and which stock's going to do better than the benchmark. But if you look at the research that was published by Dimensional Fund Advisor, this is using the data from 2004 to 2023. So almost 20 years. And they looked at 2,860 equity mutual funds. And over that period, there's 18% of them that outperform their benchmark. But there's only 45% that survive that almost like 20-year period. And what I mean by survive is that, here's the thing. When you're a mutual fund company, if you have a list of different funds that you offer your advisors, and then your advisors are pitching that to clients, if you have a fund that is not doing well, that's really hard to sell. So you kill it, right? So that's why there's a huge survivorship bias here, because there's no incentives for the company to keep a fund that it's very hard to raise assets. So what they do is just they crush it or they roll it into other ones, and then you just roll like this. So you start with 2,860, 45%. So, you lose almost half over that period, but only 1 in 5 actually outperform
of the original total amount.
Exactly.
Yeah. And so it's interesting, right? Is like what happens there is they've killed all of these underperforming funds. Then all of a sudden, the 1 in 5 of the original amount probably looks more like 3 out of 5 that are outperforming when they look at like, hey, look at our flagship funds. They've done so well over the last 20 years, right? But then what's actually happened is like they've killed 2 or 3 other ones that have been performing really, really poorly, to show you like, so it's like this illusion that like we know what we're doing, when in reality, it's kind of, they just like tried 10 different things, 2 of them worked, and those 2 are the ones they're advertising to you.
Exactly. And then if you think about fixed income, so that was the equity side. If you think, fixed income managers, maybe they have a better chance, because the fixed income market, depending on where you're investing in the fixed income market, some portion is less illiquid. So it's a lot more illiquid, so it's less liquid versus the equity market where you have real-time prices and whatnot. So the fixed income market, depending on the part, can be more liquid. So some people might say that there's an opportunity there to outperform. But if you look at the data, I guess same period, 1,655 funds to start with. Survivorship at the end is 49%. So half were gone, and then only 15% outperform their benchmark.
So 18% on the equity side and 15% on the fixed income side. So
Exactly.
outperformed their benchmark after fees were taken into consideration, I'm assuming. Because I think they always do like the net of fee, because that's such a big implication in active management. Is like sometimes you get performances that will actually beat the market marginally, right? Like maybe by 0.5% or 0.05%. But then once you factor in the trading costs, once you factor in the compensation for the portfolio management team, the fees to own the fund, all those kind of encompass into one, then you're actually now not beating the benchmark anymore. But who wins in that situation? Well, the portfolio managers are, again, the fund companies, portfolio managers are walking home with potentially up to 1% of your investment. Meanwhile, you, the client, who cares if it outperformed gross of fee? You're only caring about the net of fee performance, which only 18% have actually have actually, historically speaking, outperformed in this sample size that they're looking at.
Exactly. So the next question is, okay, but if 15% or 18% on the equity side and 15% on the fixed income side outperform, let's say 1 in 5, why do I not just invest in the funds that have outperformed?
It's a good question, right? It's like, see, I actually posted something about truths that apply in life that don't apply to investing recently. And I don't know if like a lot of people here are familiar with just like the Pareto distribution, right? Where it's like, the top is it 20% of any industry is responsible for 80% of the output of that industry, right? So you kind of think like, well, 18%, it's roughly about the top 20% of funds are responsible for probably the majority of successful outcomes. Maybe they manage the most money, right? Those types of things. But it's one of those things that I don't feel actually applies to investing when you look at it. There was a paper, I think in the early 2000s, talking about the intersection of luck and skill in mutual fund returns. I'm not sure if you're going to mention that in this, but basically looking at, are the outperformers lucky or are they skilled? And trying to find evidence of skill in the outperformance of mutual fund managers. They couldn't conclusively come to any sort of actual conclusion as to whether or not there was skill present, right? Whenever you're writing or trying to prove or disprove something, you can't definitively disprove it, but you can say there's no evidence pointing to this outcome. And that's what the authors of this paper came to the conclusion of, is that there's no evidence, even in the outperformers, that skill was the reason that they outperformed. And so when I'm like, well, do I want to invest in something that was just lucky and outperformed? That's a big question, because again, when it comes to really smart people doing really skillful things, I just don't think that translates into better returns in the investment industry as it does in the engineering industry or as it does in entrepreneurship or things like that. I just think it's a completely different way of looking at it.
No, that's a great point. So to come back to the statistics here, as far as why don't we just pick the top ones, right? The thing or the study that was completed showed that if you look at the top performing 25% based on a 5-year returns, so you have your history and you look at the top 25% and you say, hey, I'm going to pick those. The problem is that the funds that were in the top 25% did not stay in the top 25%. So if you look at the exact statistics on the equity side, funds remain, so 22% of the funds remained in top quartile returns in the following 5 years. So only 22% on the equity side and 31% on the fixed income side. So what that means is if you're looking at the top funds, there is a rotation because new funds that might have been in the second or third quartile will now become the new leaders. So looking at past performances alone gives little insight into what the performance going forward will be. And this is a big concept to wrap your head around because it's human nature. The first thing we do is we look at past returns, whether we want it or not. I mean, ultimately, it's kind of like all what we have at the surface level. Then once you start deeper and you start understanding, okay, how were those returns were generated, which that's what we try to do with clients, is try to educate them as to, okay, how were those returns generated? And to come back to the point you just mentioned is, well, if we can say that those returns were generated because of skill or because of luck, then that's a key thing to understand. And this is also one of the biggest debates in the investment industry because a lot of people will say, well, what if we look at management team and again, track record and so on. But again, if we look at the sources of returns and we break it down, and then this is going to be a segue into factor investing at some point, but we can look at any track record of any portfolio manager, whether it's a retail advisor at one of the boutique shops or an institutional fund managers. We can look at their portfolios and we can look at the returns that they got. And then we can look at their factor exposure and we can explain how they were positioning the portfolio to capture those returns, right?
Well, wasn't it Thelma and French when they were breaking out their 3-factor investing model? Basically, they said that these 3 factors explain over 90% of portfolio of all market returns, right? So like basically you could break down any sort of like really good fund that's outperformed over a really long time. And you could basically say, well, if we take away their factor exposure, like basically their exposure to different areas of the market, really there's no skill left. There's no outperformance left after we strip away the factors, which anyone could have gotten by just simple systematic exposure to those factors. And so it's really interesting. But coming back to your point on the 5-year return, why this is so important is because if you've worked with a financial advisor that doesn't embrace evidence-based investing, what you've likely gotten pitched on is this fund has done really well lately. And even though advisors aren't supposed to sell that way, realistically speaking, it's not that they have ill intent. They're genuinely trying to get their clients the best returns, as long as they're like in some sort of independent shop where they can actually, if you're at a place where they don't allow the advisors to sell anything other than their own products, big red flag. But let's say they're an independent advisor that they can provide any product out there. They're genuinely trying to give you the best returns. But the way most advisors are educated is that there's value in active portfolio management, and you can tell a good portfolio manager by their track record. And so often, and I can attest to this every day, and you probably can too, Guillaume, we are inundated with fund company wholesalers reaching out to us to say, hey, we want to take you out for lunch and show you our flagship funds, because these have done really, really well over time. And so what ends up happening is advisors go for lunch, they hear the sales pitch, then they bring that fund back and sell it to their clients. And it's always based on, this is a 5-star fund that's performed top quartile based on its relative benchmark to its peers. And this is the next best thing. And so it's really interesting too, because bringing this back to when you said the rotation out of the top quartile, like top performing funds don't repeat. One of the big reasons why is because when there's a top performing fund, let's say a fund that does 20% or 30% in a year where the index only does 15 or 20%, those fund wholesalers know that that is their time to gather more assets. So they're going to go to every advisor and say, look at what we did last year. And then what happens? Well, the advisors who, again, don't take an evidence-based approach to investing, just funnel their clients' money into those funds. And what happens? Well, the $1 billion fund becomes a $20 billion fund. And all of a sudden, it's harder to get in and out of market positions for that portfolio manager. There's less liquidity. So maybe there was skill present when it was a really small fund and there wasn't a lot of money in it. But as it gets bigger and bigger, it gets harder to move in and out of those positions effectively, quickly, and at low costs. So that's another area too. I don't know if you were going to cover that, but that's another area too that I've heard that is really hinders performance from funds that have done well in the past, and if they'll continue to do well in the future. And just don't think that my advisor knows the right funds to pick, because they're getting their information from fund wholesalers who are also telling every single other advisor in their coverage area that this is the same fund that you should be buying or selling your clients.
Yeah. No, that's a great point. It's not that every single fund out there is underperforming. Like there are some funds that outperform, but what we're saying here on this podcast specifically is that the risk, the time and effort, risk versus reward of trying to identify the best fund is skewed against you. It's not a good trade-off, because you have way more chances, as we've shown with the statistics. You have way more probability to end up in a fund that will end up underperforming than to try to pick, the winners. And then you might be lucky in picking the winners. But then as if you rotate to a different fund, then, that fund is starting to underperform. So do you see the game here? This is it can be a slippery slope. And like Sam mentioned, you always identify great outperforming fund after it has outperformed. It's never before, right? So that's the key here. And then once you start diversifying, because we see a lot of advisors doing that, and we've done a lot of portfolio reviews, especially if you're at the $1 million plus, then what you're going to find is you're going to look at your investment portfolio and you're going to maybe be with, anywhere from like 5 to maybe 10 different fund managers, right? Or fund companies. And this is just like, like a dog's breakfast, right? There's everything in there. There's different strategies, different mandate, different approaches, and it can be really messy. And when we looked at the analysis as far as, okay, the complexity, the fees, the cost versus the returns, it just doesn't add up. And that's a good segue into, okay, well, if stock picking doesn't work, or if trying to identify the best mutual fund manager doesn't work, are there more reliable ways to invest?
Yes.
Good answer.
Yes.
So one way is to, and we've covered that a little bit, maybe Sam, you want to touch on this, but do you want to explain what buying the market means? Because we say that a lot, but
yeah,
what does it mean?
It's funny, every time someone asks me what's the best stock to buy, I say all of them.
Yeah.
Because buying the market essentially means that you're not trying to single out individual companies to buy and include in your portfolio, because you don't know which ones are going to do well. Even if you think you do, again, that's a little bit of, you see an article that reinforces your belief, a little bit of confirmation bias. Everyone else has seen that article too, whatever. So owning the entire market, number one, it takes a lot of decisions off of your plate, right? Owning the entire market means you're buying an index fund that is either inclusive of all of the stocks in the market or representative of all of the stocks or bonds in that specific region, right? So let's say you want to own the entire US market, right? There's index funds available for you to be able to just say, okay, well, I'm going to put my $500,000 or $1 million partly into this index fund that owns the entire US market, every stock in the market, maybe above a certain market cap. Right. And so those are ways where, instead of trying to identify the high outperformers that are likely to be in the market, you're just buying everything, which also means you're buying some of the bad companies that aren't going to do well, that are going to go out of business. But what essentially ends up happening is you're increasing your odds of having better outcomes, in that I believe there's a statistic out there, Guillaume, correct me if I'm wrong on this, but it's something like 4% of stocks are responsible for the majority of outperformance over just like treasury bills or very low risk investments. So if we look at, like, let's say a low risk investment will return you 2% over the years, stocks that outperform that 2%, there's only 4% of stocks that are actually responsible for driving that growth. And so you've got to ask yourself, am I good enough, smart enough, willing to do the research to pick those? Or do I want to say, I have no clue which ones are going to outperform, so I'm going to buy all of them and rely on the future 4% to drive the growth in my portfolio? And that's a little bit of the psychology behind total market investing. It's like, I don't know. I don't have the time to try to figure it out. And even if I did, I'd probably get it wrong. So I'm just going to own all of the stocks through an index fund.
That's a great way. Great definition and explanation. Thank you. And just a sideway here, before we continue deeper, but if you look at just what asset class returns were, or what does it mean to, like, buy the market, what it would have looked like in 2024. I just want to review a few asset classes here for that I thought was interesting. So Bitcoin was up 121%, 2024. Annualized return from 2011 to 24 was 147%, which is crazy. Then if you bought the US growth index, so ETF, this is based using Russell indices, but ETFs, a lot of our listeners are usually familiar with that. You would have made 33% in 2024. So this is like no stock picking. You're just buying a certain part of the US market, and you're not trying to dictate which stocks within that index is going to outperform, right? So 33%, I mean, those are stellar returns. Trying to identify which stocks will be able to beat that. Again, like we mentioned, like the risk versus reward, there's way more chances for you to miss the mark than to hit those kind of returns. And those returns for financial planning, they're massively above what we usually assume to meet your financial goals, which ultimately it's the most important. But like gold, again, was 26%. US NASDAQ, so NASDAQ 100 was 25.6%. S&P 500 was 25%, and so on. So, yeah,
just pretty good returns from just owning the market.
95% of like the list of asset classes here, whether you're looking at equities, like large cap, small cap, value, growth, fixed income, convertible bonds, high yield bonds, preferred stocks, emerging market bonds, US cash, US REITs, EFA stocks, commodities, tips. 95% of asset classes were up in 2024 based on the list here that I have. The only asset class that was down was long duration treasuries, identified as TLT ETF. But yeah, so I mean, it doesn't take a genius to make money in markets like this, but it takes a lot of discipline. And a lot of people, the reason why we're sharing all this with you is a lot of people are not even capturing anywhere close to that for many reasons. Could be biases, could be being scared of market drawdowns, especially, and we're going to get to that in a second. But I just wanted to have a side note here in covering what has done well or what were the returns of a different asset classes for 2024. Okay, Guillaume, and Sam, I can buy the entire market. But the question is, can I do better than just buying index funds?
It's a good question.
Yeah. So the reason for that, why you would want to look at this is, like we mentioned in the first part of this episode, the trying to pick a mutual fund manager who's trying to identify which stock's going to do well in the market, the odds are against you. When you buy index funds, you're going into the right approach, but there's a lot of, I would say, there's a few downsides that you should be aware of. But one of them is the lack of flexibility that comes with buying index funds. And let me explain here. So when you buy an index, and the S&P 500 is an example, the S&P 500 is decided, or the stocks in the S&P 500 is decided by a committee that has a list of criteria. But those criteria are not necessarily driven by science or academic research. They just came up with those criteria, and then they're just adding stocks to the S&P 500 or removing stocks based on those criteria, right? The point is,
sounds like active management.
In some ways, yeah. And don't get me wrong here, because first of all, the S&P 500 has done extremely well. So, if you just put your money in there, but again, you might be missing out on, global opportunities, which we can cover in a second. But the point is, when you buy any index, whether it's the entire stock market in the US, whether it's the S&P 500, whether it's an emerging market or a bond ETF that is tracking an index, you're limited or you're restrained by this index methodology. So even though you're capturing the asset class return by buying that, by being exposed to that side of the market through a passive approach, so to speak, there are some downsides to that.
One of the things that comes into play here is, there's this example that Dimensional loves to use when it's like, when is the most expensive time to buy roses?
Yeah.
And it's always on Valentine's Day, right? Yeah. So when is the worst time to buy roses? Well, it's, if you're just looking at it from a cost perspective, it's on Valentine's Day. Right. And so how that segues into committees adding companies into their index, when they've announced that they're going to add a company to the index, basically the index funds have to all buy that company. And everyone's buying that company at the same time, which can make it more expensive at the time, right? So that's one of the apparent downsides to just owning the index itself, is that you may get exposure to new companies that'll do really well, but you may get them at higher prices, which can lower the next few years' potential returns on that. And so it's an interesting type of analogy to draw, but other methods of investing may be able to capture those types of returns while the roses are out of season, a little bit, so to speak.
That's a good point. To come back to the rose analogy as well, there's another example that Dimensional likes to mention as well, is, let's say you were doing your job once a year. How long would it take for your employer to notice and fire you, right? And index funds here, depending on their rebalancing methodology, they may rebalance once a year. So again, this is tied back to the concept of lack of flexibility. So like Sam mentioned, you're only owning that stocks when it's added, although it's been announced before. So you might be losing on price appreciation until it actually gets into the index, which is when you're going to start benefiting once it gets added. And because you're owning the index, you're not owning it before that. So that's what lacks some flexibility there. So it's finding that sweet spot between being active and being completely passive and just rebalancing the index once a year. So how can we find, a middle ground, right? But the question to ask is, okay, how do I set myself up for success? By finding this middle ground methodology. So taking the best of index funds and the best of market opportunities or market prices without trying to identify which stock's going to necessarily outperform by picking, 20 or 30 of them. So how do we blend those two approaches? The way you would blend those two approaches is by understanding the drivers of outperformance in the market. So if we look at the drivers on the equity side, there are three main drivers. One is company size. So smaller companies are expected to outperform larger companies over time. Then there's relative price. So value companies are expected to outperform growth companies over time. And then the third one is profitability. So high profitability company stocks are expected to outperform low profitability stocks over time. I think this one is the most easy to understand.
Right? So I think, yeah. So it's interesting because it's like, okay, that's logical, right? Small companies eventually get bigger, which means there's better returns available there. Big companies don't always continue to get bigger, although some do. And we've seen evidence of that in the last 15 years, right? Where growth companies have just been ridiculously successful, but also value companies. If my company is, the market's saying it's valued at $10 or $7 a share, but my cash flow and other companies are similar to me are valued at $10 a share, then obviously there's some potential opportunity there. And then obviously high profitable companies. But the big thing is how do we find a small company that is also value based, that is also high profitability, right? That's a really difficult. You don't find too many companies that are trading cheaply that are high profitability that are also small, right? So it's an interesting can we combine those three?
Mm-hmm.
And that's, yeah. Go ahead.
No, yeah. And the other thing that is also challenging for investors is that those are what we call factors that we expect to see in the returns in the data, but there will be periods in history, or they have been periods in history, and there are certain periods where this is not true, and it's not occurring. And there, in the 70s, for example, cash was outperforming stocks for almost a decade. Now, does that mean that, and just for the listeners, so equities are expected to outperform, a 1 month or 3 month treasury bills, which is identified as cash, over long periods of times, because equities carry more risk than a risk-free asset. So, but there's going to be periods where that's not just going to hold. And the same thing is true with small cap versus large cap and growth versus value. And I just mentioned from last year, again, US growth, just using the Russell, was 33%. And US value, you were looking at 14.2%. So again, this is a pretty significant spread again. And we're saying here that it should be the opposite. So it takes a lot of discipline to stick to those factors over the long periods of times. And those factors have been identified based on 100 years of research, of data. What, the reason behind them is because of their riskiness. So because value stocks and small cap stocks carry more risk, then you should expect higher returns.
And it's one of those few things that you can look at that you say, in the past, there's been compensation for this type of risk that you're taking.
That's
because
right.
Not every risk is compensated. You don't always get return for the risk that you take. And so it's really, really important to understand that when we're talking about small is expected to, outperform large, what we're talking about is that in the past 100 years, on average, it has, but not every year, not every decade. Right? One of the most recent decades, 2010 to 2020, it did not, right? And so those are the types of things where you hit the nail on the head. Discipline in an investment strategy usually yields better long-term results than if you're a little bit nervous and want to always switch into the things that have done well over the last 2 years or the last 1 year. That's something that you have to maintain discipline in, while still understanding that there's other things out there in your life that can also influence how you do financially, like how much you're saving. Are you paying too much tax? Are you contributing to the right registered plans? Is your corporation set up the right way? All of those other things also influence your wealth creation journey. Obviously, the investments are a little bit like the engine, right? You needed to keep going. It's got to take you over that finish line. But discipline in the investment process is always going to be key, especially in times when my investment strategy that's based on 100 years of evidence hasn't necessarily done well in the last few years, or relative to what other strategies have done. Is this still the right approach? Right? We want to look at, well, what does the science and evidence actually say is the right approach? And is this something that I'm likely to get compensated for this extra risk that I'm taking by exposing my money to value, small companies, and profitability, right? And those are the questions that we try to answer for clients over the long-term relationships with us, and keep them disciplined in that approach.
And if someone, let's say, is reluctant to pursue factor investing or pursue those drivers of outperformance in the market, I've said that to a client recently where, index funds, you will be able to retire using index funds. So that's just to be mindful of as well. Now, if you either or, I think depending, like you mentioned, of all the factors, whether it's your earning potential, saving rates, and how disciplined you are, there are some great index fund methodology that will allow you to retire. This is also an approach that you should consider, which is hopefully blended. It's blending both, and hopefully will give you a slight outperformance, not based on luck or skill, but because of past outperformance over the last century.
Yeah. And that's, again, when it comes back to the paper, is defining like, well, what's been the reason for outperformance in the market from fund managers? And if we strip away the factor exposure that they have, then really there's no skill left, right? It's all over 90% of it has been because of exposures to these different factors, which essentially is just another form of market beta, right? The market's going to give you these returns if you invest in these areas. We've known that for 100 years now. Well, we have the data to show that this has been known. I think the real research has been done since the 80s and 90s, or I guess started 70s, 80s, and 90s. But now that we have this strategy that we know has worked over long periods of time, this is a great potential for you to be able to say, okay, like I understand the risk factors here. I understand what's going to drive my returns. I understand there's going to be periods of underperformance and potentially periods of outperformance. And this is what I want to invest in long term. I think if you don't mind me explaining a little bit about how we actually share this approach with clients, and kind of the options that we give them here when we meet with clients, because we, like you said, we don't always only ever say, hey, this is the only way for you to go. Yeah.
We usually walk them through three scenarios where the first one is index-based investing. And then the second one is factor-based investing. And then the third one is socially responsible or impact investing, if that's one of the preference, which has also done really well. This is usually those three ways that we recommend you to invest in to build wealth over time.
Yeah. And that's the options we give clients, right? We're an independent shop. We're not owned by any fund company, or we don't have any strategy. Like when I left my old firm and decided to build this, one of the reasons I left was because of our lack of options to low cost, evidence-based investment models that we could provide our clients. Everything we could provide was like 2% plus, basically. And they weren't doing horribly. They weren't doing great either. And so when we were looking at, hey, I've got the option to go on the independent side and provide these different types of portfolios to my clients, that was something that was very attractive. We were able to lower their investing costs, but more importantly, we were able to get their money exposed to areas of the market that have done very well over long periods of time. And so when a client sits with us, we give them these three options. We say, and obviously if whatever option they choose, our compensation doesn't change. So we're not saying one strategy over another based on because we get paid more for one over the other. We give them an index fund strategy option. We give them a factor-based strategy option, and then we do socially responsible and impact investing if the client requests it, or if it's something that's obvious that's important to them. But the two primary ones are index funds and factor-based. And you might say, well, why would we, work with an advisor to buy index funds? And the thing there is, it's funny. I would say the prospects and clientele that we get are probably some of the most educated clients on the market. Like they've been DIYing for a long time. They've read books on investing. They understand that passive is, one of the most optimal ways to invest. But what I find is where they go wrong is there's exposure to the same asset classes with 3 or 4 different ETFs. And in their heads, they're diversified because they own the S&P 500 in US dollars and in Canadian dollars. It's that's not diversification, right? or they own the S&P 500 and NASDAQ and think that's all they'll need to own. And it's like, well, what about global? What about Canadian? What about these other areas that have done well over long periods of time and provided lower risk without necessarily lowering long-term returns, right? Which is obviously what you want to accomplish. Can we lower our risk without lowering expected returns? And so when we go the index fund route, it's okay, if you're going to go index funds, here's the exposure to the US, here's the exposure to Canada, here's the exposure to Europe, Asia, and the Far East, here's the exposure to emerging markets, here's your exposure to bonds, based on index fund approach. And we build those out for clients. And then with the factor investing, which is something that's really, really hard to get on just a DIY side, we use dimensional funds, which we've mentioned a few times here, for our clients' exposure to factor investing. In fact, the reason why we use dimensional funds is because they're essentially the creators of this strategy, the founder, David Booth, and then board members, Eugene Falma, Kenneth French. They're individuals that are advisors to dimensional funds, and they're the ones that have actually done the research to prove why factors have outperformed over long periods of time. So very evidence-based, very systematic-based. They've got multiple Nobel laureates on their advisory boards that actually help create these strategies. And so if you're going to go this route, for us, in our opinion, this was the best company to use to provide systematic exposure to those factors.
They're the gold standard in the industry for that, and implementing factor investing, especially at the cost that they're offering it as well.
Yeah.
You're talking about, let's say, 10 basis points compared to like a Vanguard one decision portfolio or an iShares one decision portfolio. So very comparable, but for the added capabilities and expertise, I think it's a very low spread to, again, like we mentioned, just buying an index, which it could be fine, but again, it comes with a lot of drawbacks as well. So.
Yeah, for sure. And we're not here saying index funds aren't a great option. I tell people, if they're going to DIY their money, listen, index funds are the best option for you. If you're going to want to see if there's extra available returns in the market, history has shown that by trying to hire a portfolio manager to buy and sell stocks, it has not been optimal. The most optimal way has been systematic exposure to factors, which this is where we can use companies like Dimensional to provide our clients with access to that. So we're not trying to say here index funds are bad and our way is good. What we do know is that if we could rank them based on history, it would probably be factor exposure, index funds, and active management. And that's kind of where we're looking at that. We're looking at like total markets and like total available products to clients. That's our opinion as advisors who've studied this and your background as well, which is definitely more technical than mine in investments, your opinion as well from studying this. So yeah, it's what we're trying to provide to clients is the best available options out there based on evidence, not based on what's done well lately.
I would say one point around DIY investors. So one of the biggest, I would say, issue that I see in DIY investors making is going back to like the dog's breakfast type of portfolio is like there's everything in there. Right? They will have the right approach and mindset with, okay, index funds are the way to go, but then they're going to mix everything. They might have a one decision portfolio. They might have, like you said, like an S&P 500 and USD and CAD. They might throw in like a small cap ETF because they've heard that small cap might outperform. And then if those ETFs are from different fund managers or fund providers, then there's different methodologies in there. So the whole thing can be somewhat of a disaster, not only to manage, but there's no cohesiveness between the exposure and ton of overlap. And that's the biggest thing. So yes, it can be simple to just say, why would I pay you to buy index funds? Well, we're going to cover that. We're financial planners and investing is only a small part of all the value we provide you. But even in the implementation side, trying to simplify it and working with a professional who knows how to mitigate those gaps is actually quite beneficial. For you. And that's a segue into why should I invest internationally? So can I just own the S&P 500 index and that would be it?
Yeah, sure. I mean, there's worse things to own, but I think I mentioned this previously. International exposure lowers your risk without lowering your expected return because it's diversification, right? And there's no greater evidence of that when we look at internationally diversified portfolios from the year 2000 to 2009, which we call the lost decade, where the S&P 500 had a real negative return over 10 years. But if you were diversified internationally, that wouldn't have been the case.
Yeah, that's exactly. If one country doesn't do as well, and again, the US, that's a very specific time period. that, has underperformed. But if you move the dates, the US has been a powerhouse. I mean, it's 50% of the global stock market. It's where all the biggest companies, many of the biggest companies are situated or located. So our headquarters, sorry, that should be the right word. So of course, it's easy to say that it's the most followed markets as well. So it's easy to be only invested in there. But again, the argument is, even though the largest companies in the US have a large portion of the revenues from overseas, they're still very much exposed to the political situation in the US, again, anything that's happening to the US specifically. So that doesn't give you true diversification. If you want true diversification, you should be better off to include companies that are headquartered in
Europe, Asia, Far East, the international side. Yeah. And it's interesting because what was the country last year that actually performed the best? It was Israel. Right.
Oh.
We were just on a webinar looking at what were the asset classes that performed very well last year, and Israel beat out the US. And so we look at it's obviously a very niche case, but people have it in their heads that the US is always ever the best performing stock market, and that's not true. There's periods of time where European countries, Middle Eastern countries have outperformed. Right. When we're looking at that, it's not always about being number one all the time. It's about and this is really honestly, Guillaume, what it boils down to, is my portfolio generating the required rates of return for me to hit all of my financial goals? And what's the lowest risk way for me to do that without sacrificing the returns that are needed to get me there? And that is truly boils down to the essence of what investment planning and financial planning come together. That's what it comes down to. And so if we can achieve that, then that is, with our clients, that is what they're looking for.
But Sam, what about those hot tips that I'm hearing about?
Yeah, I like to just say, enjoy the entertainment, but ignore them. At the end of the day, what matters is, are you on track to hit your goals with the portfolio that you're currently invested in? Everyone wants to make more money, right? So I'm not saying don't try to make more money, right? But at the end of the day, when you're reading things or hearing things on the news or watching social media, watching the inverse Kramer ETF or the Nancy Pelosi portfolio or something like that, right? What you have to understand is that these are not strategies that really a disciplined investor is going to want to go after. At the end of the day, while yes, you want to increase your returns over time, I think what the goal should be here is to say, I'm going to be disciplined in my approach. When I chase after trends or chase after hot tips, inevitably that comes crashing down and someone's left holding the bag, and inevitably it's usually you, it's usually the retail investor. So why chase that, right? Even for me, why spend your time trying to find that? You have a career, you have a family, right? Maybe it's just a hobby for you. But there's so many more productive things that you could be doing than trying to guess where a hot tip is going to take you and try to gamble into that. And really it comes down to, don't gamble with your money, right? If you have a budget that you enjoy gambling and you want to do it with that. Don't do it with your retirement savings. The probability of success is so low, and the probability of failure is so high that you're going to essentially invest your money into a casino when you start doing those types of things.
Yeah, that's a great point. I think one thing that I've learned, I would say notice over the years, is that when people start accumulating significant wealth, and let me explain. Let's say you cross the $1 million mark in your investment portfolio and you were invested in a globally diversified portfolio in 2024. You're up, let's say, close to 20%. That's $200,000. Now that might be in a registered account. You might have to pay taxes and take it out of retirement, but the point is, once you're making those types of returns, that's putting you well above your retirement goals. And the hardest part is your first $100,000, saving that, but also you getting to your first million. And then at some point, you will cross a path where your savings, your returns are going to be outpacing your savings by a large margin. And once you get to that point, this is how compounding wealth works. And that's why it's so important to focus on your earning power. And then, of course, your saving rates, which are things that you can control. But the goal is once you understand that, then those hot tips are meaningless. The reason a lot of people try to chase those hot tips is, especially maybe they're not there yet, or they're trying to make that quick buck. And as you know, when you're trying to take the fastest route or take shortcuts in life, and this is whether it's fitness, nutrition, anything, it's rarely yields the best outcome. It this slower and steady and consistent, persistent. This is whether it's, you're building strength, getting fitter, changing, your nutrition and whatnot, investing, and then it takes a ton of patience. But yeah, what should I do about when the market tumbles then?
What should you do when the market tumbles? I tell clients a bit, basically I kind of tell them a bit of a story. So here's a guy, his name's John. In January of 2020, John slipped into a coma. And John didn't go through all of the craziness with COVID in 2020. He didn't see the market drop. None of that happened. He had a pretty big amount invested in his portfolio. And it just so happened that he woke up on December 31st, completely healthy, fluke, right? Now he's able to just continue life as usual. And of course, one of the first things he does is checks his portfolio and sees that it's up almost 20%. Thinks, oh, it's a pretty good year in the stock market, right? But what happened that year? Well, the market dropped 30% in a month, recovered 40% in the next 2 months, right? So if we constantly pay attention to the little things that happen on a daily basis, the news, again, news is designed to bring out fear, to elicit fear, because that's what attracts the most eyeballs, right? It's a money game. They're trying to attract the most viewers. So the negative headlines always do that. Essentially, you're going to fall prey to taking advice from people who don't know your life, who don't know your situation, and who really don't know what they're talking about. And I say that with all due respect to the really, really smart people on TV. It's not that they're not smart. It's just that they don't know whether the current market crash will continue, will correct, will go back up, or will be prolonged. They're just guessing. And if you follow their train of thought, then that's going to lead to poor decisions in your portfolio. And I know there's a lot of data out there showing that in almost any positive year in the markets, there is a period of time where the returns are negative, right? And if every time that happens, you make that decision to say, I'm going to get out, or I'm going to reposition my portfolio, or what I'm in isn't doing as well as some of my buddies' obscure third-party private stuff, I'm going to move into that. All of a sudden, you're just making decisions that are not going to improve your financial situation long-term. So my advice to people, tune out the noise. Just enjoy your life. Markets are going to do what markets are going to do. Market downturns are the price you have to pay for good long-term returns. And that's as simple as it is.
Yeah. And it sounds so simple and easy. And somehow it's so difficult and complicated for some people. And it took me 10 years to get where I am today. I went through a lot of ups and downs personally and through my career to get with that peace of mind and that confidence and that understanding of how markets worked, and having that being emotionally what's the right word?
Self-aware, emotionally sound,
self-composed. Being composed through different markets environment. Yeah, it took a lot.
Yeah, it's not. I said simple for a reason. I didn't say easy, right? And because a lot of simple things are very, very hard. And people often tell me, but I really like watching the markets. I like wondering what things are going to do and trying to see. And I kind of question that sometimes. Do you actually, or are you just really emotionally attached to your portfolio? Anyways, but I think the best thing that you can do for your money is to make sure it's invested the right way from day one, consistently save into it every time you get a paycheck, make sure that it's optimized from a tax perspective, and that it's not tinkered with, that it's not consistently traded on, that it's not consistently changed. It's just going to be the best outcome for you long term.
Mm-hmm. And stay invested. That's the key, right? When you look at the statistics, so here's the stats from 1999 to 2023. So again, 20 plus years. If you invested $1,000 USD, this is using the S&P 5, the Russell 3000, index as total return index, you would have accumulated over that period, $6,500 to make it easy. This is the growth of $1,000 USD would have grown to $6,500. But what if you were scared of the market crash and you would have maybe sold and go to cash, right? And then there's different statistics here, if you missed the best week, the best month, the best 3 months, and the best 6 months. So I'm just going to quote you the last one. So if you missed the best 6 months, you would have ended up with $4,000 just over $4,000 instead of $6,500. So that's a 35% less by missing the best 6 months. Now, over a 24, 25-year period, I mean, 6 months is not a whole lot. So if you go to cash at any point in time with that period and it ends up being the best, that can have a significant impact on your overall wealth accumulation.
And it often is. It often is because people get so scared around markets during downturns that they don't think logically that, well, there has to be a recovery. And what happens in recoveries? Well, they're higher than normal returns, right? Because you're at the bottom of the market, and over the next year or 2 years, markets usually recover. And those 1 or 2 years often bring over average returns back into the portfolio. And if you're just really scared, then you're just going to miss out on that.
That's such a good point. So if you look at the 1 week, the best 1 week, guess the date, November 28, 2008. So literally close to in the bottoming phase or so to speak.
So how, sorry, question here. So that was the best week in the markets in the last how long?
Between 1999 and 2023, using the Russell 3000. Yeah.
So the best week in the markets over the past 25 years happened in the worst year in the markets in the last 25 years.
Yeah, put it that way. Exactly.
Wow.
Yeah. And then the best month happened, guess what? April 2020. So
April 20, yeah.
So in March, the US shut down. And then after that, so that following month, again, that was crazy, but still the best 3 months happened in June 2020. So again, March, April, May, June. And then the best 6 months ended in September 4, 2009. So the following year. So this is exactly what you mentioned, where of course, because when prices are depressed, you want to have higher expected return going forward. And then when prices are, and I don't like this word like overvalued, but when prices are higher, then you would expect lower return going forward. This is true in asset classes, whether it's housing, equities, fixed income, you name it, right?
Absolutely.
So with that being said, when is the right time to invest?
Good question. And I think the right time to invest is when you have money to invest.
Yes.
Yeah.
That's a good,
yeah. I don't know if I need to expound on that, but I think that's literally the best time to invest is when you have money to invest.
That's a great, and depending on the goals as well, especially it's for retirement. Get this, I love this statistic so much. I should invest when the market drops, let's say 10%, or I'm waiting for a market drop for 10%. So this is using the S&P 500 index annual returns from 1926 to 2023. So almost 100 years. So what's the difference between investing at the top or waiting until the S&P 500 drops more than 10%? Okay. So the 1 year annualized return is 13.7% when you're investing at the top versus 11.5% when you're waiting for a pullback. So your returns are worse when you're waiting for a pullback. And a 3-year annualized return is almost a coin toss, 10.6 when you invest at the top, 10.3 when you invest after the drop. And then a 5-year annualized return is also closer, is 10.2% when you invest at the top versus 9.6% when you wait after a pullback. So it's getting closer, but I think one of the reasons here is because of momentum breeds momentum. So as prices are going up, it's normal to see higher highs or new highs. We want to see new highs, and the best years have seen most number of new highs. So I know it's scary, and you don't want to be that sucker who's investing and then the market just drops in your face. But being okay with facing new highs every day is something that you need to be comfortable with to be able to compound wealth over time.
Well, think about it this way too, right? Like you're looking at the classic person who says, I'm going to wait for the market to drop 10%, or I'm going to wait for a market correction before I invest. Let's say someone said that we're talking about the S&P 500 here. Let's say someone said that in January of 2024 and said, I'm going to wait for the market to drop 25%. And then we see in 2024, the market goes up 25, and they're still saying that, right? And then let's just hypothetically assume that in January or February of 2025, the market does drop 20%. And they say, see, I got it. But what actually happened is they missed out on 5% of opportunity cost. And so they're actually worse, even though the market dropped by 20%. hypothetically speaking, in February than if they had just invested in January. And so we often sit ourselves on the sidelines while markets improve. And we kind of say, well, we want to get invested here. Markets go up and then they come down here and then you're investing there, instead of just investing it when you had time and opportunity to do that. Now, there's a bit of different ways. Like sometimes, people have a lot of money to invest that they came into all at once, and they're nervous about investing it all at once because let's say it's $1 million they just got from an inheritance. And if they invest all of it at once and the market does drop that 20%, then all of a sudden $1 million turns into 800,000. That takes a little while to get back up to $1 million, right? And so there's that nervousness and that risk. And so we kind of always have these conversations with clients about, do we just invest all at once when we're talking about large lump sums, or do we dollar cost average it into the market, which simply means we're going to do 10% a month for the next 10 months, right? Exactly. And what happens there is if there is a drop, then only 10% is effective. And then you can buy in at that 10% drop with the next 10% of your money. Now, historically speaking, because that is a lower risk investment strategy, that has breeded lower returns over the long term. However, you're taking risk off the table, and that's not always a bad approach when you're talking about large amounts of money that you have to make capital decisions with or investment decisions with that capital all at once.
And just to confirm, you're talking about investing over time. So systematically deploying money over time is carrying lower risk versus trying to put everything at once, which makes sense because once you put all your portfolio on day one, then you're exposed to market risk on day one. But if you spread it out over, let's say, a 2-year period, then you carry less risk. So if there are fluctuations within the time that you're deploying the capital, you will have less of a impact on your overall net, your portfolio wealth or portfolio value versus if you're
exactly. But then you run into the situation where if markets continually increase over that period of time, you're averaging up in your cost basis. If the markets are going down, you're averaging down, right? Which obviously is the preferred scenario, is that actually markets do continue to go down so you can get in at the lower prices, but that's not going to always happen. So you're taking potential returns off the table by, let's say, if you'd done that in 2024, you would have missed out on 25% potentially of $1 million capital initial investment. So you would have seen lower returns, but again, you took lower risk. So that kind of makes sense. It's trade off.
So the last part is, how can a financial planner help? But do you want to comment a little bit on how we help clients beyond investment planning and maybe touching on like the areas that we cover as financial planners?
Yeah, absolutely. So we do a lot around goal setting and goal funding. And so if there's a certain lifestyle that you want to achieve, certain goals that you want to hit, certain things you maybe thought are out of reach, we can help you actually pull them in reach and show you how to fund them, show you the trade-off, show you what you can do with your money. There's that aspect of it, which I think is probably our most rewarding aspect, where we get to show people, hey, you didn't think this was possible, but actually if we just do a couple things, here it is. And here's how. I love that part. We do tax planning for clients insofar as we don't necessarily advise or implement on the specific structure, but we can identify and help clients where they're being tax inefficient in terms of their registered plan contribution strategies, in terms of their corporate structure, in terms of their compensation strategies, like how they're paying themselves from corporations. And then we have a fantastic accounting and legal partner that we refer our clients to, or we work with their existing partners to say, hey, we think this is inefficient. Here's a few proposed strategies, and those will then get implemented on the legal and accounting side. So there's that aspect. We build out retirement plans, long-term education plans, all of those things to make sure that, again, those goals are funded. We also do insurance and risk management for clients. So we've got all of these grandiose visions and goals, and your family is all set up to accomplish them. We need to make sure that your future wealth is protected. So we'll put insurance plans in place in that aspect. We obviously do the investment planning side. So aligning the portfolios to accomplish your short, medium, and long-term goals. It's obviously very important to make sure that it's money that is needed to buy a house in 2 years is not invested the same as the money that's needed to fund your retirement. We help on, again, some of the more menial tasks, like making sure installment payments are being made on time for clients, making sure that we're reviewing the portfolio annually or at least semi-annually, and providing quarterly updates and reports. We make sure that if you're a tech or an equity compensated employee, that we have the schedule of when your RSUs or stock options vest, and make sure that you're exercising them at the right time, and that being tax efficient with it and being properly diversified. I mean, there's so many different things that we work with, and I probably forgot a few, honestly.
Yeah.
Yeah.
No, that's great. I mean, to some, like my favorite, like you mentioned, is the non-financial impact that we have on our clients, whether it's helping you spend more and, enjoy your life to the fullest, bring you that peace of mind that your future is taken care of while you can enjoy your life today. I mean, this is probably my most favorite. When I have a client that I did a plan and he went and bought a car because I put $1,000 car payment in there as a line expense. They were not sure. And anyway, now because they're welcoming a new addition to their family. So, and I was just go to see people enjoying their lives based on the peace of mind that you bring them. And then also like the financial aspect, which is where Sam mentioned, where we bring you practical, tangible strategies and solutions to make a difference, and with your financial affairs. So yeah,
absolutely.
So just a last call to action. If you've listened all the way to the end, give us a rating. So if you're on Spotify, it's just using the stars. Very easy. Leave a comment if you're on YouTube or on other platforms. You can visit us at mwadvisors.ca if you want to learn more about our services. And if you want to book a meeting, you can also subscribe to our newsletter there. And don't forget to follow us on socials. The links are in the bio. And thank you for listening, and see you in the next episode.